I think there's more room to be less hawkish now with inflation closer to their target than where they were a year ago. So I do believe that they're willing to have a little more inflation in the system to help the labor market from cratering. But that's a real test. The question that we often get is, will central banks explicitly change their target? And we don't think so. We think that would be a really bad idea. You can't change the rules of the game midway through, right? It doesn't invoke confidence into the institution. But I think it's one of those things where they'll allow a little more tolerance than they have historically for protection of the labor market.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup-Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunne.
Thanks very much for that introduction, Niels. Today, I'm delighted to be joined by Greg Peters. Greg is Co-Chief Investment Officer of PGIM Fixed Income and is one of the co-heads of the multi-sector team. Greg has been in the markets for a long time. Prior to joining PGIM, he was Morgan Stanley Global Director of Fixed Income and Economic Research and Chief Global Cross-Asset Strategist. And earlier in his career, he worked for Salomon Brothers and at the Department of the US Treasury. Greg, great to have you with us today. How are you?
I'm great. It's a pleasure to be here, Alan.
Well, thanks for joining us. We always get our guests just to kick off by giving a brief intro to their careers, how they ended up in markets and economics. So if you wouldn't mind, can you give us a quick overview of your route to becoming PGIM's co-head of fixed income?
Yeah, it's a circuitous path, which I think oftentimes is the most interesting one. So I started out with the federal government here in the U.S., the Treasury Department, on the tail end of the savings and loan crisis. So it was a fantastic experience as a bank regulator going through that time. And what was great about that is that I had a tremendous amount of responsibility, probably too much responsibility for a 22-year-old, but I really learned a tremendous amount and really used that as fuel to kind of broaden my understanding of different parts of lending and markets and structuring. And so it was really fantastic. And then I moved there to basically Salomon Smith Barney, which was acquired by Citi. And I was on the mortgage side, mortgage derivative side, then moved into research. And what's funny about that is that I moved out of trading into research, and it was something that I was really quite upset about. But the reality is it was the best thing to happen to me. It fit my personality. I learned so much. It allowed me to delve deeply into issues and to use my broad-based knowledge. And so it was fantastic. And so I grew up on the research side. And then about 10 years ago, I moved to PGIM to manage portfolios. And it's been it's been a great harmonious type of career in that respect.
Good stuff. And obviously, you're heading up the team at PGIM Fixed Income. I'm one of the co-heads on the multi-sector team. So in terms of the types of portfolios you're running, can you give us a sense on those?
Yeah, so they're broad global fixed income. There is a whiff of equities here and there, but mostly fixed income for sure. But we're in every single market globally. Credit, we're quite known for credit, from high yield levered loans, investment grade corporates. Structured products is a big part of what we do. And so from CLOs to CMBS to esoteric ABS and the core sovereigns. So on the multi-sector side, and as a CIO, it's about putting together these component pieces, creating an asset allocation scheme that, pushes you up and out the efficient frontier. And so utilizing all those different tools and instruments, that's what we do on the multi-sector side.
Okay, great. Well, we've obviously had a lot going on in fixed income this year. It's been a very interesting few months. So it's very timely to have you on to get your perspective. Maybe firstly, from an economic perspective to set the stage, obviously coming into the year, a lot of expectation around recession and the economy has been very resilient. So good to get your perspective on why that has been the case. And then obviously looking ahead, I guess a general expectation of a soft landing now, and I suppose a virtuous scenario of declining inflation and rate cuts being priced into markets. How do you see things? Well, firstly, were you surprised about the resilience of the economy, and how do you see things playing out looking ahead?
Yeah, so just kind of zooming out for a moment, and then I'll delve into it. I think importantly and critically, we are in the midst of a series of secular shifts. I think growth is on a different plane globally. I think we broke out of this secular stagnation story. Part and parcel to that is the influence of China into the global economy is very different and will continue to be very different across multiple dimensions. Inflation also, I think, in a different realm than what we've seen before. Geopolitics as well, the importance of geopolitics. I also think there's this, trend in place where there's a return to labor, focus on labor gains away from return to shareholders, and then enwrapped by central banks as the reaction function of central banks, given those secular shifts, is very different. So I think we're in a different world, a different regime, and candidly, I'm not sure investors have completely accepted or let's say agree with my assessment here, but I think it's really quite important. So that I don't want to sound melodramatic about the whole thing, Alan, but at the same time, I do think it's important. And that gets me to the resiliency. You go back 18 months ago, 2 years ago, and the prevailing wisdom is that the economies would not be able to withstand higher interest rates, right? And I mean higher interest rates off of zero. So we've clearly moved well above that. And I think that has been a surprise to everyone, myself included. So that's for sure. Going forward, we're pretty positive on the global economy. We think about the world in a scenario-based way, probabilistic way. I don't believe in kind of a single point forecast type of measure. So if you just allow me to kind of walk through how I see the U.S. economy as an example, we have we'll start with recession first. We have a 25% probability of a recession in the U.S. which is clearly lower than what was talked about last year, but still high, right? It's still 3x what the normal probability is. So we still have to be vigilant around that downside tail, which makes it tricky from an investment standpoint, right? When the downside tail is 3x the normal tail, that is something that clearly influences asset allocation in markets. We have a soft landing probability of 15%. And then we have what we call this weakflation, which is our modal scenario of 35%. And weakflation is essentially an environment where GDP is slightly below trend, 1.5%, with inflation remaining above target. And so that's our modal scenario. And then the other scenarios we have are more bullish, actually. We have a nominal GDP boom, we call it, and a roaring 2020s. And really the scenarios there is, stronger growth, a much more favorable backdrop economically. But if you put it all together, the mass of the probabilities are quite favorable. And we have this tail. So we're pretty constructive, actually, on the global economy, as we think there's elements in the economy that has shifted, as I mentioned before. Productivity is one aspect, and we're on a different growth plane. Okay,
interesting. And I mean, obviously, it's been, as I say, been an interesting year in fixed income. I suppose if you were to trace the trajectory of bond yields maybe over the last 18 months or so, obviously for a period we had Fed tightening, but bond yields been slow to fully respond to that and the curve steepening, the curve inverting. And then as we went into the summer of this year, there was that sharp catch up in long-term bond yields and a move up in 10-year up to 5%. And then since then we've had a rally on rate hope expectations. I mean, taking those bits in turn, were you surprised at that kind of initial period when you had such an inversion in the curve and the long end didn't respond as much? And then secondly, how did you see, what were the key drivers of that catch-up phase as we went through the summer?
Yeah, so I think, in short, it's the market's been pushing against central banks. There's not been an acceptance of what central banks have been telling the markets, right? And so the curve's been inverted essentially because the belief was rate cuts are on the come and this can't stand, right? I'm oversimplifying, but I do think that's the core of it all. And there's, technical influence that, maybe help the back end of the curve and those types of things. But the bottom line is, markets have been pushing back on central banks and not listening to central banks. And you still have it today. And I also think the markets have not fully appreciated the new regime that we're in. So here, let's go back to March of 2022, so March of this year. We had a regional banking wobble here in the U.S. The concerns clearly was a systemic shock to the system. But what was notable about that event was how quickly and severely the markets repriced the front end. So literally in, a half a day, the front end in the U.S. priced in, 200 basis points of cuts instantaneously. What's notable about that is inflation at that time was above 6%. Growth was strong. And I know banking crises are scary, of course, but the snap reaction in the markets is that cuts. And that really emboldened us around kind of our positioning as we feel the markets are utilizing this outdated playbook, as it's really difficult for central banks to cut rates when they're above target on their inflation. And growth is, still reasonably strong. So, I think that was a very important event for us in our thinking. So the way I kind of been looking at it all along is that the markets have been volatile around the rhetoric of central banks. and the acceptance of that rhetoric. And it's still that way today, honestly. There's been a big rally in the bond market here as the belief is central banks are done, which is likely true, but really continues to push the envelope around forward rate cuts. And to me, that seems heroic.
Okay. And I mean, obviously the other big theme in terms of fixed income and bonds at that time during the summer was around debt sustainability, which, had been in the background for a long time, but didn't seem to be a market concern, and then suddenly appeared as a market concern, but equally has kind of gone away just as quickly. I mean, how is that something that you're concerned about? And when you look at both the issuance outlooks going ahead and the likely composition of the demand side, how I suppose relaxed are you on the outlook from that perspective?
Yeah, so I never accepted debt sustainability as a reason for the sell-off earlier this year. I think that was a kind of a politically driven red herring in many respects. I think it was really just boiling down to the pushing back on central banks more than debt sustainability. I will say, though, you look at fiscal deficits and they are quite eye-popping. In the U.S., it's the worst fiscal deficit that we've had, without a recession or war. These are very eye-popping type of numbers, and it does matter. And so, this is something that we know doesn't matter till it matters. But I do think it's been important from a pricing and market structure standpoint. So that fiscal deficit obviously has to be funded. You have a lot of treasuries coming to the marketplace. That treasury supply has to be absorbed at a time when the compositional shift of buyers have changed, right? And so, right, if you look at who's buying this new supply, it's really quite interesting. So we know that foreign investors have stepped away from the US Treasury market. I don't think there's a nefarious backstory there. I just think there's a home bias type of element as yields have increased across the globe. And so there's just less demand for that. So as a consequence, what we've seen is a real shift in what we call the household share. So if you look at the shift in who's absorbing this record supply, 73% is coming from the household. Now, the household is interesting because 90% of that household is hedge funds. So hedge funds are in that household category. And so what's notable about that is, a hedge fund type of investing, and this is done on this basis trade, element, is they're more sensitive to price, right? So the marginal price setter is much more sensitive to the pricing. And so that creates a lot more volatility in the marketplace and makes the markets much more fraught as a result, as global investors coming in are not as sensitive, right? And so I think this is the big story in the market and driving the volatility and the moves in the marketplace more than anything else. So while I'm not worried about debt sustainability per se, the supply that's coming out and the market absorption and the composition of the buyer base has shifted so dramatically that's the knock-on effect.
Okay, interesting. And obviously, you mentioned the kind of reduced demand from foreign buyers, and obviously, what we're seeing outside the US is a shift in the yield landscape as well. And obviously, I mean, is that something to be concerned about from a US perspective in terms of, say, Japan, for example, and with the ultra low yields there we've had for the last period? anecdotally, I haven't looked at the data, but the theme has seemed to be of Japanese institutions investing overseas to pick up yield, and now concerns that may be unwound. Obviously, if that was the case, it would have multiple implications across a number of asset classes. Where do you see things in Japan?
Yeah, so I think that is really important as we think about 2024. I think the consensus is that the BOJ is finally going to tweak their policy. That I do think is important. I do think that will have a marginal impact on those global flows. But at the end of the day, the interest rate differential is just so large still, right? So, you look at it and it's really quite dramatic as the gap has just really grown quite dramatically over the past few years as global central banks have moved up rates and BOJ hasn't, right? But it's about hedge costs and the FX, right? And so clearly the FX, the yen is under pressure here. It's stabilized somewhat, but it's still, under pressure. And it's just basically the interest rate differential, right? That's driving it. And so that coupled with the hedge cost just really puts Japanese investors in a really tough spot as it's really quite costly for Japanese investors to go outside of Japan, just given the interest rate differential and the hedge costs. So I do expect that to be less hateful, I guess, in 2024, and will have impact on the margin. But I don't think it's a wholesale change, but it's definitely a marginal change that bears watching, no pun intended.
Okay. And I mean, obviously, as you say, there's a growing expectation of a Bank of Japan move. And obviously, we've already had incremental changes in their yield curve control. So now the next step is obviously a move in official rates. I mean, from a bond market perspective, how high do you think yields in Japan could go? And secondly, there's some suggestion that you might start to see financial repression in Japan in the sense of private sector institutions being encouraged or a bit of moral suasion being enforced for them to buy JGBs if the Bank of Japan is going to be less active in buying government debt. Is that a scenario you think is plausible?
Yeah, I think it's plausible. I would say financial repression has been going on for quite some time, so that's not a new phenomena. Perhaps maybe the buyer base changes on the margin. But I do think there's this just natural home bias, this domestic bias. And I think that is something that will help. So I don't know if it has to be a formal financial repression type of program. I think it happens more naturally than you think, I guess.
Okay. So, and I mean, in terms of you're not concerned about a kind of a big spike in JGB yields and then having a kind of a tail impact on global markets?
Well, it's a concern, but I think it's a remote one. I think it's a remote one. I don't see that as a mortal scenario by any stretch, but it could happen. But I also think the BOJ is quite vigilant around that. And it's another form of yield curve control. And so I worry about it, but it's not a predominant worry.
So I know you've written a little bit recently around the theme of yield is destiny in terms of the kind of the investment outlook and asset allocation outlook. So maybe if you could just, what does that mean, and what are the implications for investors?
Yeah, so I think if you go back, and I think history will go back and shine a very unfavorable light on this zero and negative interest rate policy. It crushed savers. It had a lot of unintended effects, and ZIRP and QE and all these programs were about. It's about affecting the portfolio channel, to use central bank parlance. And in short, what that means is they forced investors out the risk curve, and uncomfortably so. as they made owning cash and fixed income instruments just so unattractive. So I think that was unnatural, right? So the sell-off has been quite acute. I'm fond of using this path destination example where it's like going on a family trip where, oftentimes in the car, with the kids and the dogs, it's not quite a pleasant experience. But once you get there, it's good, right? Once you get to the resort, it's all fine. And I kind of think about the journey of fixed income as a family vacation over the past 2 years. So yield is destiny is just the higher income that one receives from fixed income is back to what fixed income was intended to do, right? So income's in the name, and it's about yield and carry. And we're in a much better yield and carry environment, and that starting point matters a lot. So if your starting yield is at 1%, as an example, your prospects for return is really quite muted. But when it's 5%, it's much better. And if you look at it over history, when yields are higher, returns are higher, right? It's not rocket science. You just get more income, more into the door. And so yield is destiny is just a reflection of higher yields. And the bull market is actually the yield itself, right? So, and I'm one of the few folks, I think, who don't want a fixed income rally. I want yields to remain higher, as I think that is really what investors and savers need. So I think the worst possible outcome would be, going back to where we were in 2020 or 2000, that period. I think the prospects for kind of return and a balanced asset allocation scheme is much worse in that environment.
Okay. And I mean, a couple of follow-up questions to that. One is obviously, yields touched 5% or so. Now we're back to, 4.20, 4.25. I mean, where do you see that in the medium-term range? Are we in the middle, towards the bottom, or how would you, in terms of what you see as the kind of the normal range in this kind of new environment that you painted?
Yeah, so I think the range is wider than what we've been accustomed to. So, we have like 100 basis point range, which is quite wide, right? So, but that's the volatility that we see in the marketplace. So it's not completely out of bounds. But, we see a range of between 5 and 4%. That's the range that we see. And I know that's not a sharpened pencil answer, but we do see yields higher. We're in this higher for longer type of camp, and so we're seeing curves starting to normalize and yields higher, and that's our forecast.
And obviously, higher for longer was maybe an accepted view going back 2-3 months, but the market has shifted a little bit, obviously, in terms of pricing and rate cuts now. And I guess the case on that front is we've had a fall in inflation, so real yields have gone up, and obviously inflation is heading back towards target. So even in the absence of a slowdown, there could be a case for cutting rates. So do you think that inflation will be stickier than people expect, or do you think that narrative is incorrect in terms of your belief in kind of higher for longer?
Yeah, so the fall in inflation has been miraculous, right? In many respects, it's the disinflation that has come through the system this year has been really notable, and I think you have to give central banks a lot of credit for that. And so I think that's a great story for sure. At the same time, there's this debate in the market, and even within our own shop, the last mile, right? Is that the easy part or the hard part? I'm in the hard part. So a lot of measures that we look at it seems to me that even in the goods sector, which has really seen inflation come down meaningfully, right? That was the sector that had the supply and demand shock hit at the same time during COVID. Obviously, prices skyrocketed as a result of that. That has really normalized as supply chains opened up at all. But there's still more inflation there than our models are predicting. And so to me, I'm reading that as there's something in the system that is not being captured. And I think it's important to remember that inflation modeling, inflation forecasting is quite fraught, to be kind, right? So it's really difficult. Economic forecasting is really difficult. Inflation forecasting is difficult squared, right? So we have to be humble around that. So I'm in the camp that inflation is more sticky than what we've been accustomed to. The important part of inflation, particularly in the U.S., is the service sector, right? So it's a big part of GDP, of course, but it's 56% of the core PCE basket, and that gets me to labor, right? It's really difficult to see the service sector inflation come down meaningfully when we're at close to record unemployment rates. Wages are still rising, albeit at lower levels. And so I think that's a really difficult inflation piece of the puzzle to shake out. So in short, I think inflation will remain above that 2%. And that gets me to Fed policy and central bank policy. And so, yes, we do see some scope for modulating, being less restrictive, still restrictive, but less restrictive. And so we're penciling 50 to 75 basis points of cuts. So you're still in restrictive territory. And we think there's cover for the Fed to do that. But the markets continue to push more and more and more. And that's where I disagree. And it goes back to this persistence above or below the 2% target. So we're coming out of this long era of central banks not having to contend with inflation because it's been persistently below that 2% target. Now, I believe it'll be persistently above. And that changes the degrees of freedom that central bankers have to cut rates. And so that's the disconnect between kind of my way of thinking and what the markets are pricing it.
Okay. And I mean, that stickiness you took, I guess that's related to some of those structural themes you mentioned at the outset and possibly maybe that return to labor being a driver. And I guess the labor market being a bit tighter and labor supply and not as ample. Is that the case? And also, the kind of other factors that people talk about in terms of this kind of longer term inflation outlook are around deglobalization and decarbonization. So, I mean, how important would you weight those factors in terms of that view? Is it more the labor market view, or is it as much those other structural themes as being potential drivers of a slightly higher inflation rate over time?
No, I agree with that. I think this change in globalization, matters a lot. We see, and more importantly, hear less so than see talk about onshoring and friendshoring. I think that's been more rhetoric than reality at this point. But the clear desire is to bring supply chains closer to home or at home. So for the U.S., that's hugely beneficial for not only the U.S., but Canada and Mexico, as an example. This green initiative is costly, right? And so, you're spending on both, right? You're spending on near-term energy security, as an example, and long-term solutions that are different, that are decarbonized. So that what is definitely inflationary. I think those are, definitely big drivers. And the labor side is key, of course. And I view the labor story as critical to a more balanced economy as well. So I think a lot of the issues, both politically and economically, have been driven by inequality. As if you look at the gap has just really grown quite substantially over the past couple decades, and seeing a return to labor, wages moving higher is a clear benefit for a more balanced economy that's more sustainable. And so I think all else equal, that puts more pressure on inflation as well on the margin. So I agree with you, Alan.
And I guess the flip side, I mean, the thing that people might point to as being the wild cards that might counter all of that is on the productivity side. And obviously this year we've had a lot of talk about AI and generative AI and ChatGPT and all of this stuff. And but we have seen it, after a long period of very poor productivity numbers. The most recent one was a movement in the right direction. Where do you sit on that side? And is that something that could propel the economy into a higher growth path and and contribute to maybe offsetting some of the concerns, that's kind of supply shock concerns?
Yeah, so productivity is also quite tricky to model. Oftentimes, you don't realize there's a productivity boom until it's past or you're deep into it. You think about the Greenspan era as an example, but that is a key driver of our potential bullishness going forward. So it's tenuous, but we do see productivity gains that will allow the global economy, the U.S. Economy in particular, to grow more and get out of this secular stagnation story. And just thinking about the U.S. for a moment, we are actually really quite constructive, quite bullish on the U.S. on a medium to long-term basis. We think there's real potential for the U.S. to be a clear winner here. As China, we see in secular decline. We can talk hours about that, I'm sure, and different components. But we see the U.S. as a clear, undeniable winner here, and a lot of it has to do with technology, a lot of it has to do with labor, and a lot of it has to do with rule of law and FDI and capital attraction and those types of things. And so we're quite constructive on the U.S. Here over the medium and long term.
Okay, so that's probably a good segue into talking about China, and it sounds like you're much more upbeat on the US vis-a-vis China on a multi-year basis. Good to get a sense on how you see the longer-term outlook playing out in China and its implications for global asset markets.
Yeah, so I think that is a big secular shift. The influence of China on global growth, so the second derivative growth, is not going to be what it was over the previous 20 years. I think that's an obvious statement, but a lot of it is just the maturation process, right? Whether it's an economy or a corporation, is just really difficult, if not impossible, to continue to grow at that rate. But the issue with China is that it's getting old before it became rich. And so there's lots of comparisons to Japan, and for good reason. But the key difference between Japan and China is that per capita GDP in Japan, 3 times what China is. So it still hasn't created the wealth, right? And I think that's an important distinction. And then that gets you to the 3 major headwinds, right? You mentioned, Alan, demographics. You're seeing an outright decline in working age population. That will continue. So they also don't have a social security net underneath, right? So that is a real tax on the economy for sure. The second is deleveraging. So the property sector, is front and center, of course, but their property sector is 3 times larger than the U.S. Before the GFC. So it's a big source of deleveraging and just general de-risking, right? And so it's kind of reinforced by the current government and Xi really crushing animal spirits in the private sector. I don't think they will have the ability to track foreign flows, which is critical to help support that economy. So I see China in a really difficult spot here over the next 10 years. And I think that matters in how we think about emerging markets, how we think about global growth. And it's just a big change from what we've experienced over the past 20 years.
And obviously there's going to be multiple channels by which that may impact the economy and global asset markets. Will it still have the same kind of level of current account surplus that it needs to recycle? And do you think it'll be more a disinflationary force or more of an inflationary force, or sorry, maybe less of a disinflationary force, I guess, for the global economy? Or I guess, what would you say is the most obvious implication of all of that in terms of, is it weaker economic growth and then for global asset prices?
I think the most obvious one in my mind, at least, is around commodity prices. But I think China propping up commodity prices through their growth will be quite different going forward. So I see that as a source of disinflation in terms of the commodity side. But I also see an inward focus, and you're seeing it today. Even the contours of GDP is shifting or attempting to shift, and it's less focused on global trade, right? It's more inward looking around consumption. And so that, all else equal, doesn't drive global growth in the same way, and has less of an influence on inflation. So as I kind of put the China story together with the onshoring, friendshoring, I see that as an inflationary force, not a disinflationary force. And so that's kind of my view of it.
Yeah. And from a global fixed income perspective, obviously, I guess a weak China growth trajectory, and as people draw parallels with Japan, you might expect, we might see rates trending down and possibly the need for more unconventional policies there. Is that a bullish scenario to invest in Chinese fixed income, or do kind of geopolitical concerns outweigh that and concerns around the currency? Or how do you think about China as a potential component in a global fixed income portfolio?
Yeah, so to me, the geopolitical concerns are front and center. I mentioned about our bullishness of the U.S. and the rule of law matters to investors. And I don't think you can say the same when you talk about China. So the fragility of those rules are important. If you look at the opportunity set, it's mostly in the property sector, which clearly is under pressure for quite some time to come. So no, I don't really personally see it as a opportunity. I also see lots of constraints given the amount of leverage that they have in the system of what they can and can't do from not only a policy standpoint, but from a monetary policy standpoint. So no, I don't see China from a fixed income standpoint as a real kind of destination at this point in time.
Okay. And I mean, more broadly, I suppose one of the interesting themes over the last number of years has been, maybe within the emerging market side, a bit of a emerging market central banks pursuing policies that were, I suppose a little bit more independent from the developed market and now being maybe at the forefront in terms of the easing cycle. Is that an area of opportunity, or how do you see EM debt from a sovereign and a local markets perspective?
I think so. What's notable about this cycle has been led by emerging markets as far as central bank policy is concerned. They were the first to raise rates, first to cut rates. So definitely have led the charge here. I do think there's an opportunity in emerging markets, particularly as China becomes less influential, right? Those other emerging market countries will step in and fill the gap in my mind. So I do think there's a real positive outlook for EM. The tricky aspect of EM is that it's very bifurcated, tricky and opportunity at the same time, but it's very bifurcated. If you look at emerging markets, you have the higher quality EM countries. Let's define it as investment grade. They're doing really quite well, but there's not a lot of value from a fixed income perspective necessarily. And then some of the lower quality problematic countries come with a lot of risk. So it is very much of a security selection type of marketplace in EM. And I guess the difference, which I view as a positive, honestly, the difference of EM markets today versus historically is that it's less of a singular trade and more of a idiosyncratic trade, which I think shows to the maturity of that market over the past 20 years. So broadly EM, I'm not excited about per se, but there's lots of opportunities within, and I do see emerging markets benefiting here over the next few years for sure, and longer than that.
Just come back to what you said at the very beginning around the secular shifts that we're seeing, and we've talked through most of them at this stage. But one of the things that I've noticed was that you touched on was a difference or a change central bank response function, maybe going forward versus the past. Curious to get your thoughts on that. Obviously, there's a general, possibly there was a sense in markets last year of an end to the Fed put. Is that part of your thinking, or what are you thinking in terms of the central bank response function?
Yeah, so I think the put has changed, and I think the central bank reaction function has changed in my mind simply due to inflation, right? You go back to what I was saying before around the persistence above versus below the 2% target. And I just believe if you're above that 2%, the degrees of freedom that you have to cut interest rates is much more constrained than if you're below. And I think that's more than a subtle shift, right? I just think, if you're a central banker and you don't have to worry about inflation, which, by the way, is the mandate, right? And in most cases, the sole mandate. I just don't think it's so easily dismissed, and so that's really driving my thinking more than anything else. It's just that a simple but important input. But as far as the put is concerned, well, I guess there's other ways to have puts into the marketplace, and you did see that in March of this year in the U.S. around the regional banking crisis, right? So the continuation of these new programs, lending programs, will continue, and they'll provide liquidity into the system just in different ways. So I don't see the Fed put as an example as an interest rate put. I see it as a program put. And so they will continue to liquefy and make sure the market functions. And it's less obvious, but still quite apparent as an investor.
Okay. And I mean, in terms of, you have, as you mentioned, 25% chance of recession. If we started to see more serious signs of economic slowdown as we go into next year, but inflation is still, running at maybe core levels of around 3% or so, that would create the dilemma for central banks, which they haven't been presented with to date. How do you see that scenario playing out? Do you think they're more likely to be hawkish and point to the 3% is still too high, or will they say, well, taking a forward-looking view, given the weakening of the economy, we can still cut rates, or what's your sense on that?
Yeah, so what you described is the worst possible scenario for a central banker.
Exactly.
Right?
Yeah.
It's somewhat of an intractable problem to solve. But I think it goes back to the labor market. I think labor is key not only from an inflation standpoint, but from a growth standpoint. And the tricky part around the labor piece is that it's quite volatile and it's late cycle. And so oftentimes what you see is a real strong labor market right up until the end, right? And it just goes, I think central banks know that. So I think there's more room to be less hawkish now with inflation closer to their target than where they were a year ago. So I do believe that they're willing to have a little more inflation in the system to help the labor market from cratering. But that's a real test. The question that we often get is, will central banks explicitly change their target? And we don't think so. We think that would be a really bad idea. You can't change the rules of the game midway through, right? It doesn't invoke confidence into the institution. But I think it's one of those things where they'll allow a little more tolerance than they have historically for protection of the labor market.
Okay. And in terms of, as you say, you kind of mapped out a kind of a distribution of possibilities in terms of distribution, soft landing, weakflation, and a more upbeat scenario. Within the recession or even, the hard landing possibility, what are the areas that you're focused as the potential weak spots there? And what are the kind of signposts that you're watching in terms of the high frequency data that would tip you off that maybe we're heading in that direction more than one of the other scenarios?
Yeah. So what's unique about this cycle, I would say, in some respects, is that there's not a lot of excess built into the system. Some view that as a reason for a shallow recession if we do have one, right? I see it a little different in a way. So the excesses that I see are in the credit markets and outside the traditional credit markets. And so if you go back to the GFC, there was a clear desire by regulators to diffuse the risk across the banking system, which is to push it outside the banking system, right? And so as a consequence of that, you've seen an explosion in private credit, even levered loans. And so what I worry about that is, one, it's opaque, so it's really hard to have a true understanding. But, I think about, higher for longer rate impact on these capital structures. There's been so many capital structures, whether it's real estate or corporations, built on the back of zero or low interest rates. With rates higher and cash flows lower, that puts a lot of pressure on these capital stacks. And so I see a higher than normal default rate environment, distress environment, regardless of a recession or not. But if a recession does hit, then I think that's where the stress and strain is going to be in the system. And what I worry about is that the central bank / fiscal ability to fix that is really quite challenged. So they lost control. Effectively, regulators and central bankers lost control by diffusing the risk outside their sphere. And the fiscal thing is important too, as we started this conversation around the deficit. If in fact we do hit a recession, the fiscal impulse that you typically receive in that environment, I think, is severely constrained, just given where we are today. Now, never underestimate a politician's ability to change, their commentary. But it is a constraint that is something to factor in. So you put it together, less fiscal impulse. Central banks are constrained by inflation. that suggests to me if we do have a recession, it's not simply going to be a shallow one, because those tools that typically are available may not be available this time, which means it'll float lower from an economic standpoint.
Okay. And so, I mean, in terms of the kind of credit and the default in the private credit sector, is the point that, I mean, part of I suppose the view was that as lending kind of transitioned into private credit markets, if there was defaults and problems there, it wouldn't be systemic. It wouldn't. But presumably, if private credit lenders are suffering losses on loans, they will equally retrench as much as traditional banks would. So it presumably would amplify a downswing in the economy. Or what would you think?
No, I think that's quite right. And the opacity of it all makes it more challenging, right? But just in simple terms, there's just been an explosion of growth in that area. And history tells you that, you look for where growth has really ramped up in a meaningful way, for a problem, right? And we saw it in housing, of course, back in 2006, and today I see it in private credit.
Okay, good stuff. Well, I'm conscious that we're coming up on time, and we always like to ask our guests before we wrap up in terms of things that have been influential in their careers and pieces of advice they can pass off to people who are maybe starting off. What would you say to people who want to get better clued into economics, global macro and global macro investing, and any suggestions on things to read or to do?
Yeah, it's funny. I tend to look at readings, books, articles, oftentimes outside the financial world. I personally learn a lot by reading history. For me, for example, when the markets get crazy, which it's been crazy for quite some time, I have this belief when things speed up, I want to slow it down. And then I also want to tune out the white noise. And so, I typically read a lot less of the financial daily news, don't watch financial TV, and I read history or something that helps ground me, as oftentimes that historical perspective is far more influential in how you invest and your thinking than listening to or reading a reiteration of the same thing over and over again. So that's one of my tools or tricks, I'd say, Al.
Okay, well, very good. Greg, thanks very much for joining us today. It's been a great conversation. I've learned a lot. And so for all of our guests, make sure to follow Greg's work, because as you can tell from today's conversation, we're living in a truly global macro-driven world, and it's more important than ever to stay informed. So from all of us here at Top Traders Unplugged, thanks for tuning in, and we'll be back soon with more content.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.